Hi guys, welcome to another video with Optionables. I'm Saket and in this video we are going to know more about short straddles. So we have been getting queries regarding which is our favorite trading strategy, and it is definitely short straddle. And in this video we are going to examine why exactly we feel that short straddle is superior to other trading strategies. So we are going to divide this video into four. The first part of the video is where we understand what exactly are short straddles and how do you create it. In the second part of the video, we are going to take some data, do some analysis and try to see if short straddles are actually better than other strategies. And in the third part of the video, we are going to examine why short straddles can be little better, slightly better than short strangles. And in the fourth part of the video, we are going to take some live trades of optionables under different market conditions and see how short straddle has worked. So if you guys are liking the content on the channel, please hit the like button below, and also don't forget to subscribe to the channel. And there's links to Telegram, Instagram, Twitter below. So please make sure that you also join and follow us on respective platforms. So we'll quickly be moving on to the video now. Hi guys, so this is the first section of the video where we try to understand what is short straddle and how exactly we can create a short straddle. So here what we have is we have open Zerodha Kite and we are going to see what exactly or how exactly we can create short straddle. So one thing what you have to note here is when you're doing short straddle, you will have to round it off to the closest at the money option. So for example, if it's 32,904, the current level of Bank Nifty is 32,904. So what you're going to do is you're going to add 32,900 calls and 32,900 puts. So if you buy 32,900 calls and 32,900 puts, it is going to become a long straddle. If you are going to sell 32,900 calls and 32,900 puts, it is going to become a short straddle. So all you have to do is round off the spot to the closest whole number. So in case of Bank Nifty, the closest strike is in the multiples of 100. So the closest strike will be 32,900. In case of Nifty, the closest strike will be 14,800. So if it was above 25, then the closest strike would be 14,850. Since it's below 25, the closest strike or the nearest round off is 14,800. So from here, what you are going to do, so to create a short straddle, you will have to place a sell order. So since this is today the markets are not open, so this is going to go as a dummy order. So I'm going to place a market order. So you're going to short a CE as well as you're going to short a PE. So when you short a CE as well as you short a PE, you're going to in turn create a short straddle. So this is how you create a short straddle, and this is what is called as a short straddle. So for example, now if I ask you to create a short straddle for Nifty, so the closest strike is 14,823. The closest to that is 14,800. So you're going to add a 14,800 call option, 14,800 put option. To create a short straddle, you're going to short this one lot and short this one lot. So by doing this, you will be creating a Nifty short straddle. So now let's try to create for a few more stocks. Let's say we will take example of HDFC Bank. So HDFC Bank is currently trading at 1,420. So what we are going to do, HDFC Bank 1,420, a call option, put option, and you are going to short both and you create a short straddle. And in the next section, we are going to see, or we are going to dig for some data and try to see why short straddle is actually going to benefit you a lot. Okay, so welcome back guys. This is the second section where we are going to see how exactly short straddle is going to help us, or how short straddle is slightly better than other strategies. So for this, what we are going to do is we are first going to open Sensibull, which I have already done. So you can see this is the screen of Sensibull, and I have created a short straddle here. As you can see, I have shorted a 32,900 call as well as 32,900 put. I have shorted, that is of 12th May, and I have got the following payoff. So you can see here, if the market moves up violently, that is if it goes towards 34,000, 35,000, I'm going to lose money. Whereas if the market falls down also violently, then still I am going to lose money. Which means if the market is range bound or if the market consolidates, only then I am going to make some profit. So if there's a big up move where the market moves towards 35,000, I am losing money. If there's a big down move where the market moves towards 30,000, I am going to lose money. So only if it is between a small range, and that is what we can see here. So as long as it's between 31,961 and 33,839, I am going to make profit. So this is almost around 900 to 1000 point range. So as long as the market is between this range, I am going to make profit. So now, if this is the case, then why do we say that short straddle is actually so good? Because you can see here the loss can go to any extent. Here on this side, the loss can go to any extent. So why do we still say that short straddle is actually good? So here since we do intraday short straddle, we will have to understand the intraday movement of markets Nifty as well as Bank Nifty, and that is what we are going to do now. So here what I have done is we are going to come to these charts later. So this is data of Bank Nifty from 2012. So 2012 till, so we have the data till December 2020. So we are going to go down. You can see here we have data till December 2020 from 2012. So we almost have 8 years of data. So here I have calculated intraday movements in terms of percentage. So here it gave us 0.18% negative, that is open to close. I have calculated intraday movements, and you find that so totally there are 2203 trading days between 2012 January 1st to December 2020. So out of this 2203 trading days, the market moved between plus or minus 1% for almost 1458 trading days. You can see I have a Excel function put in here. So if the market movement is less than plus 1% and more than minus 1%, then I have used a count function. So it has counted all the numbers between plus 1 as well as minus 1%. So you can see here totally we have 1458 days where the market has stayed between plus minus 1% and it is range bound. Plus minus 1% is just around 300 points, and there are around 745 days when the market has either moved more than 1% intraday or more than minus 1% intraday. So when we take this, you are going to see both the charts here. So I have plotted both the charts. You see that movement of Bank Nifty. So you can see the graph because visual representation is always better, and you also see that there's a 66% chance that the market is going to stay range bound, and there's a 34% chance that the market is going to move violently. So when there is a 66% chance of market staying range bound, that means a neutral strategy is always going to give you profits, and that's the reason we have chosen a neutral strategy, which is a short straddle. So this will obviously lead us to the next question. So if a neutral strategy is going to give us profits, then why not short strangle, and why are we going for short straddle? So this is what we are going to address in the next section of the same video. So here what you have to understand is most of the days, over 66% of the trading days, the market is going to stay range bound. So only around 34% of the trading days, the market is actually going to move plus or minus 1%, more than plus or minus 1%. In this, we also saw data regarding why a neutral market strategy is going to help us. So when you know the data, you really don't have to open the charts. Will Bank Nifty move up now? Will Bank Nifty come down now? I have absolutely no idea. The beauty is I don't have to have any idea. If you see in Optionables, we never open charts while trading because we don't have to know, because we have the data which suggests that the market is going to stay range bound. So how does it matter to me if Bank Nifty is going to go slightly up or slightly down? Because the data suggests 66% of the times the market is going to stay range bound. This is all I need to do profitable trades. I don't have to have a super trend analysis or anything of that sort to actually predict the market. So if I have some strong supporting data, that is more than enough. So this is second part of the video where we found out why a neutral based market strategy is better than any trend based market strategy, because most of the times the market is going to stay range bound. So hope you like the second part. Next we are going to move on to find out why short straddles are better than short strangles. Okay, so now welcome to the third part where we are going to explore. So in the market neutral based strategy, why is short straddle better than short strangle? So here you can see that I have done a short straddle which I already showed in Sensibull. So I have shorted a 32,900 put as well as 32,900 call. We already discussed how to do a short straddle. Okay, so now we move on. And also we have done a short strangle here. You can see that I have shorted 32,600 puts and 33,200 calls. So it is not the same strike price. I have moved 300 points away both. So on the put side I have moved 300 points away. On the call side I have moved 300 points away. So when I make a short strangle like this, so this is called a short strangle. So if I make a short strangle, you can see here that sometime my profit will be flat. So whereas if I do a short straddle, I will have a V-shaped, but when I do a short strangle, I am going to have a flat profit and then I am going to come down. So my profits are going to fall. Initially I am going to have a flat profit for a small range. Here there is no flat profit, instead it's a complete V. So why is this better than this? So first we are going to come and look at the break evens. So here look at the break even. Okay, so it is 31,961 to 33,839, right? 31,961 to 33,839. So we are going to go back to strangle and look at what exactly is the break even. I have done a 300 point strangle here. So here it is 33,929 to 33,871. So you can see that the payoff or the break even has just increased by 40 points. In spite of me going away 300 points, my break even has just increased 40 points. So from 31,961 on the downside, it has just come down to 929, which is not even 40 points, it's 32 points. And even on the upside, it is very similar. It has just gone up 32 points. So okay, now the break even has definitely increased, right? So it has increased, whether it's 10 points, 5 points or 1 point, it has definitely moved. So now for increasing my break even just by 30 points, what is the price am I paying? So you can see here the max profit I can achieve is only 16,700, whereas the max profit I can achieve here is almost 23,475. So you can see that just to increase my break even by hardly 30 points, I am letting go of profit which is almost 50% more than what I get in short strangle. So this is the difference I am talking about, short straddle and short strangle. So you will hardly be increasing your probability of profit. You can see here it's 58%, it becomes 60%, and your break even is just 30 points away, that's all. So it's only 30 points increase, for which you are going to give up almost around 50% of extra profit. So this is what we are talking about as to why short straddle is better than a short strangle. So you can see here, instead of 23,475, so we are going to do that 23,475 and divided by 16,775. So you can see here you are going to increase your profits by 39%, 39.94%. So for 39.94%, you are just letting go of 30 points of break even. So in spite of this, people still prefer strangle. I will tell you why exactly that is also. In strangle, you are not going to have violent M2Ms. In a straddle, you are going to have violent M2M. So in spite of having almost similar break even and higher profits, you are going to have violent M2M swings. So it's going to go up, come down, go up, come down. Whereas in a strangle, the M2M swings are much more silent, not violent. So for this reason being, many people prefer strangle because they are not really bothered about higher profits. All they want is a calm trade. So they don't want a violent trade where they get tensed, it goes down, comes up, goes down, comes up. So a calm trade is sometimes preferred by traders compared to a huge M2M swing. That's the reason they prefer strangle over straddle. But at Optionables, we don't find any reason why we should go for a strangle compared to a straddle. So because our break even is more or less the same, we are going to let go of lot of profits otherwise. So we personally prefer doing straddles over strangle. So this is the third section of the video. Hope you guys have liked it. So before reviewing the trade, I am going to show you something else also. So this is little complicated. So we are going to use option Greeks here, but instead of that, I am going to simplify the concept and show it to you on Excel. Okay, so this is one more Excel table which I have made, and this is how generally the premiums actually act. And I'm quickly going to explain what this means. And so this actually, to understand this, we have to know well, like in depth about delta as well as gamma. Since I'm trying to make this video simple, we don't have much time to understand that as well. I'm just going to explain what we see on the screen, and I'm pretty sure all of you would have experienced this, and that is for sure that everyone would have experienced this. So let's say I do a straddle here, strangle here, and I'm shorting calls trading at 500 rupees and puts trading at 500 rupees, calls trading at 200 rupees and puts trading at 200 rupees. So now let's say there is a 100 point immediately within next 2 minutes, there's a 100 point up move. So we have considered theta to be 0. There is no effect of theta at all. There is no effect of vega. So when you remove effect of vega and theta, so let's say there's an immediate 100 point move. So this call option is going to go to 555 and this put option is going to fall to 455. So you are going to have a loss of almost 10 points. And you can see that when there's a 200 point immediate move, so you are going to have a total loss of 20 points from a short straddle. So this is considering there's no theta. And when there's a 300 point move in Bank Nifty very quickly, you're going to have a loss of almost 40 points. So the call option has gone to 670, whereas put option has come to 370. Whereas in a strangle, during the first 100 points move, you are not going to see wild M2M swings. But later you can see that at 300 points move, a strangle is going to give you more loss than a straddle. So why do you think this happens? That is because from 200 points, an option can't come down to 0 immediately. Whereas from 200 points, an option can move towards 500, 600 pretty quickly. So if an option is at 50, assuming, from 50 tomorrow or right, then it can't become 0 because it has to go till expiry to become 0. Whereas the other option, in case of a violent move, can end up becoming 200, 300 or even 500 from 50. So this is very much possible. And since the downside of the option is limited, in out of money options, the calls and puts are going to lose premiums lesser than the opposite, like gaining. And this is explained by, I'm just going to show you the graph and tell you exactly why that happens. So let me just Google delta graph of option. Okay, so you can see here, the delta graph is going to look something like this. Okay, so this is the delta graph of a put option. You can see -1 to 0. So you can see the graph here. So the delta of call option is going to be very similar, but the thing is it is going to be little opposite because it starts from 0 to +1. So it is going to come like this and go up like this. So because it's 0 to +1. So what you have to remember is the slope is still going to be the same. Even though it comes on the other axis, the slope of the curve is going to be the same. And here this basically shows 1 point move for every point in underlying, every point move in underlying. So when you're starting at 0.5, let's say both puts and calls are at 0.5, so you can see the slope is more or less same. The rate of change of delta is more or less the same. But if you end up starting here, so when you do for example, when you do a strangle, you will usually end up starting here at 0.2 or 0.3. So now you can see the difference. So now what happens for an option to lose, right? For an option to lose, the rate of change is very low, but for an option to gain, the rate of change is very high. So you can see one leg immediately starting to gain, whereas the other leg doesn't have the rate of change of loss is very less. So you don't see the premiums actually losing that much. So this is a little complicated to understand as a graph, but this example will be helping you to simplify the entire concept, why exactly this happens. So everybody would have seen this happening. An option won't go to zero immediately, whereas the other leg will end up shooting up higher. So I have tried to explain the concept of delta and gamma in this pretty quickly. So this might be a little confusing, but I hope the other explanation prior to this is quite clear. Yeah, so next I am going to show you certain traits, and then that is the final session where we are going to see how short straddle has worked out in different scenarios. So welcome to the final section of this video, and here we are going to see some live traits where how short straddle has actually helped us in different situations. So here the thing is, I don't have a recording of all the traits because I make the video and delete it immediately. So we are going to see the latest recording, and then I'm also going to show you a couple of screenshots of previous this thing, and we are also going to see the chart and try to understand how the market moved on the particular day. So here we have the first chart where we have lost 1,72,000. So before we move on to this, I would like to tell, so many people have this misconception that option selling gives you unlimited loss. Short straddle has an unlimited loss. So all you have to do is just place a stop loss and your loss gets limited, and the other leg will start giving you profits. So you don't have to do much. All you have to do is just place a stop loss for both legs, and as soon as one leg stop loss gets triggered, the other leg will start giving you profit, and there is no question of unlimited loss at all. So there is a very big misconception that option selling leads to unlimited loss. So when do you actually go to loss when you do this? Let's say it hits the stop loss on one side and again comes down, or let's say it hits your put stop loss and bounces back, you are going to go to loss. If it hits your call stop loss and comes down, you are going to go to loss. If the market stays range bound, you are going to make profit. If the market is trending, you are going to make profit. If the market goes up, consolidates, you are going to make profit. If the market is going to go down and consolidate, you are going to make profit. Only if there is a V-shaped move, it goes up, hits and comes down, or it goes down, hits and comes up, you are going to lose money. And that is what exactly happened here. So this is 3rd of May 2021. We have a loss of 1,72,000. So we are going to now see what exactly happened on 3rd of May, which gave us a loss. So I'm here going to use 10 minutes chart, and yeah, so this is 3rd of May. You can see here, usually we take afternoon trades, right? So the market fell and there was a bounce back. So it came down here, triggered the PE stop loss, bounced back. So when there's a V-shaped move, here it came down, triggered the PE stop loss, bounced back, this constituting to a V-shaped move, which means we will be under loss. And that is what exactly happened here. So since it was a V-shaped move, we booked a loss of 1,72,000. Yeah, so I have already uploaded a video on this, so you can go and check that out as well. So next we are going to come to 4th of May. So here is the most interesting thing. Why did we have 78,000 profit? So I am going to show you what exactly happened on 4th of May. So you can see here, entire afternoon session, the market just fell and fell. So as per what we saw in this graph, whenever there is a huge down move, we have to go to loss, right? But the stop loss got triggered somewhere over here, and then the market just fell. So once the stop loss gets triggered and you have the market continuing the same trend, you are definitely going to make profit. So that is what has happened here. You can see 4th of May screenshot, and we have made around 78,000 profit. So we actually booked it very early. If we had let, it would have easily crossed 2 lakh and odd. So we booked it very early, so it was a mistake from our end, but yeah, so it would have given you a very good profit. And finally we will come to the latest day, that is afternoon session. The market fell, and you can see from 12:30 absolutely no move, absolutely no move. The market consolidated whole time after 12:30. So 12:30 it was around 32,871. It just went up around 100 150 points, came down. So we have the recording for this, we are going to watch that. So I think that is 7th of May, and yeah, you can see here, I'm just going to fast forward the video and come to the end, and you can see that the market 7th of May is what we are looking at, and you can see that we have got a profit of almost 91,000, and the market has just not moved anywhere. So this is why short straddles are so good, because in a consolidating market you're going to get profit, in a trending market you're going to get profit. Only if there's a V-shaped move like how we saw on 3rd, we are going to lose some money, and loss is part and parcel of the game, and it is something which can't be avoided. So yeah, so this is the entire video on short straddle. So this is when we lost money. So loss is a part and parcel of the game, and something which can't be avoided. So once in a while you're going to have a loss, but that is pretty fine. You're going to have many more profitable days. So for example, Thursday was a complete day of consolidation. During the last hour, if you see on a Thursday last hour, absolutely no move. So here you must have seen our Thursday video, but here you can see last hour absolutely no move, and it gave us a profit of 10 lakh. So this is how short straddles are going to work, and that is why we like short straddles over other strategies. So hope you liked this video where we tried to cover all aspects of short straddles. If you have any questions, please do drop in the comment section below, and we will try to come up with many more such videos soon. And please don't forget to hit the like button and comment your views down in the comment box, and also share this video with your friends. You can follow us on Instagram, Telegram, as well as Twitter. The links are in the description. You can also check out the previous videos where we show our live trading videos. You can check that out as well. And yeah, thank you for joining in. Hope you have liked the video. Catch you soon in the next session.